Is Bitcoin really heading toward $200,000? It might sound like another round of overhyped speculation, but the numbers are pointing to a much more grounded, data-driven story. In today's video, we're going to break down a powerful and often misunderstood force that could send Bitcoin's price soaring, the supply shock. We'll walk through what a supply crunch actually is, why institutions are loading up, and what this might mean for your portfolio and the entire crypto market. This is one of those moments in the cycle where understanding what's happening under the surface could give you an edge. So let's get into it. A supply crunch or supply shock is when the available supply of an asset starts to decline, while demand either holds steady or increases. It's a fundamental economic imbalance, and when that happens, prices tend to spike. Now, Bitcoin is uniquely positioned for a supply crunch because of one key feature. Its supply is capped at 21 million coins. That's all there will ever be. But in reality, the number of coins actually available for trading is far lower. Why? Because many have been lost, literally. Wallets have been forgotten, keys misplaced, and early miners may never return to the market. Most estimates suggest that between 4 to 6 million Bitcoin are permanently out of circulation. That brings us down to somewhere between 14 and 16 million coins actually available. But even that number is shrinking. Now here's where it gets interesting. Institutional demand has hit unprecedented levels. We're talking about investment firms, ETFs, private companies, and even some national governments. These aren't speculative retail players. They're serious buyers with long-term horizons. And together, these entities now hold well over 15% of Bitcoin's total supply. But here's the twist. These massive purchases aren't always reflected in price movement right away. Why? Because they don't happen on public exchanges. They happen over the counter. These are private deals, quiet, off the books. A company like MicroStrategy doesn't go on Binance to pick up 1,000 BTC. They call up Coinbase or another OTC desk and buy direct. So, while the market might look quiet on the surface, under the hood, Bitcoin is being steadily removed from circulation. That's the beginning of the crunch. And it doesn't stop there. It's not just institutions buying. Long-term holders, often called diamond hands in the crypto space, are also clutching their Bitcoin tighter than ever. According to on-chain analytics platforms like Glassnode, less than 25% of Bitcoin's total supply is currently liquid. That means the vast majority is either lost, held by hodlers, or sitting in long-term cold storage. Even OTC desks, which have historically been the safety valve for institutional demand, are starting to run low. Their reserves are thinning. And when that happens, they'll have to start sourcing Bitcoin from public markets. That's when we could start seeing real upward price pressure. And don't forget about the miners. These are the people who bring new Bitcoin into circulation every day. You'd think they'd be selling constantly to cover operational costs. But many of them aren't. Instead, they're holding on to their Bitcoin. In some cases, they're using it as collateral to raise capital rather than liquidating it. That reduces sell pressure even more. So fewer coins are entering the market, while demand continues to rise. This is the textbook setup for a supply shock. But if all of this is happening already, why hasn't Bitcoin's price exploded yet? That's a good question. The answer lies in market dynamics. While institutions are buying OTC, many long-term holders have been selling on the spot market, particularly around key psychological levels like $100,000. This creates a kind of tug-of-war. Institutional accumulation supports the price from below, while retail profit-taking suppresses it from above. But that balance might be shifting. Spot selling from whales is starting to slow. Their reserves are depleting, and once that sell pressure disappears, demand may finally be free to lift the price significantly. So when could the supply shock actually hit? The timing is tricky. It largely depends on how investors behave. If Bitcoin starts to be seen not just as a speculative asset, but as a true safe haven, like digital gold, that could be the catalyst. We're already seeing signs of that shift. Events like a central bank announcing it holds Bitcoin, or a sustained decoupling of Bitcoin from stock market trends, could help tip the scales. As more people start holding Bitcoin with long-term conviction rather than flipping it for short-term gains, the liquid supply continues to shrink. And that's when the feedback loop kicks in. Tighter supply drives higher prices, and higher prices encourage even more holding. So how high could Bitcoin go if a full-blown supply crunch takes hold? Let's look at a historical parallel. In the 1980s, the Hunt brothers famously cornered the silver market. They bought up a third of the world's silver supply, triggering a supply squeeze that sent silver's price through the roof, multiplying several times in just a few months. If Bitcoin followed a similar trajectory and its market cap grew from its current $1 trillion to $4 trillion, that would translate to a Bitcoin price of around $200,000. Of course, it could overshoot that level in the heat of a FOMO-driven rally, but $200,000 is a very real target in that kind of a supply-driven move. Now, let's not ignore the risks. Bitcoin is still volatile. Prices can fall just as fast as they rise. As the price climbs, more traders start using leverage, which can amplify both gains and losses. When things turn, they can unravel quickly. Also, big psychological price levels like $200,000 attract profit-taking. Many long-time holders may choose to exit, especially if they've been in since $10,000 or earlier. And regulatory threats remain a wildcard. A crackdown on stablecoins, for example, could rattle the market and derail a rally. And then there's the broader market to think about. If Bitcoin does go parabolic, what happens next? A major rally would likely lead to more Bitcoin being wrapped and used as collateral in DeFi. That would unlock billions of dollars in stablecoin borrowing. A portion of that money would flow into altcoins, Ethereum, Solana, meme coins, and the like, creating a rising tide effect. But when Bitcoin corrects, the reverse happens. DeFi loans get liquidated, altcoins crash, platforms built on borrowed capital get wiped out. It's the double-edged sword of a supply shock. At the end of the day, Bitcoin is approaching a pivotal moment. The supply is drying up, demand is accelerating, institutions are committed, miners are hodling, the macro backdrop is aligning. And on-chain data is flashing bullish. Will it guarantee a $200,000 Bitcoin? The setup is there. The conditions are in place. And if you're watching this space closely, you know something big could be coming. If this helped clarify what's happening under the surface of the Bitcoin market, give it a thumbs up, hit that subscribe button, and drop a comment to let me know what you think. Is the supply shock already happening? Or is the real move still ahead of us? Either way, stay sharp, stay informed, and I'll see you in the next one.